So, in the interest of the markets being crazy right now, I think it's so important to talk about portfolio hedging. And a lot of people don't necessarily talk about portfolio hedging when it comes to options. You typically see conversations portfolio hedging conversations centered on hedging stock positions. But I think it's important that, especially if you're a swing trader, but period, you need to know what your total risk is in the markets at any given time. And I'm not going to go deeply into this. This is just going to be more technical based, and I'll discuss a couple of tickers that I would consider to be good hedges potentially for your overall portfolio, whether you're trading options or you're hedging against stock positions. And I may do a video later on down the road that'll talk about how you can um, figure out what your total risk is when it comes to your options positions, and how to come up with a way to strategically hedge against your options position. Because a lot of us are out here with a bunch of positions on, and we may not be aware of uh, our bias in that portfolio from a quantitative standpoint. So definitely important conversation to have. But before I get into the discussion itself, be sure to go to my latest course that I did with By the Hood University. You can check out their YouTube By the Hood podcast on pretty much any podcast network. They're available there. Great platform. But we partnered and released another course centered on price action. We call it God Charts and So Shall You. We also call it Charts and Price Action. So you can go to chartsandpriceaction.com or godchartsandsoshallyou.com, and you can check out the latest offering centered on charts and price action. If you have any questions, feel free to let me know. If you're new here, please consider subscribing to my channel. And for those of you that continue to support, return again and again, leave comments and engage. I appreciate you guys for sticking with me. And if you have any suggestions about things you want to see me talk about in the future, feel free to let me know what you think, and I'll be happy to field whatever your suggestions are. But let's go ahead and talk about portfolio hedging. So, as I mentioned in the introduction, portfolio hedging is just super important and not just for investors long term, but it should be important part of your strategy as a short term trader as well. So I think that uh, for beginners, typically people would hedge with tickers like VIX, so volatility. They would hedge with gold. They would hedge with bonds and things like that. And let me say, there's no one right way to hedge your portfolio, because what some people do is, let's say you are tech heavy in your portfolio, right? And maybe there's a narrative in the markets that tech is, like right now, tech is underperforming, and maybe um, some other industry or sector is overperforming. Maybe something like consumer staples. So maybe you hedge your tech portfolio with a company in the consumer staples area, and that can be options or stocks. Or you could say, maybe my portfolio is very bearish, in that, I'm really heavy on the put side. And so what I could do to reduce the risk in my portfolio is put on some bullish positions in bonds, or um, you know uh, something else that may have some relative strength against my portfolio. So, like I said, there's no one right way to do it. People do all come up with all kinds of creative ways to hedge against their portfolios, but understand that hedging your portfolio is designed to reduce your risk in your portfolio. So, if I'm hedging my portfolio, um, and my risk is more so to the upside, then I would be hedging to the downside to reduce the risk and to bring down the risk of that bullish bias. Just in case something happens, then I'm able to reduce some of that risk on the upside with that downside move that comes in the markets. So anyway, I was on a call tonight with some of my comrades, and we were talking about gold. And gold is one that I've been following over the past few weeks or so. After I saw a $12 million spread on the tape, and I don't remember the date, but it was sometime in April, where someone or some entity. Uh, Entered a long straddle position. And so, based on that information, I was able to decipher some key levels based on that order itself. And so, I pretty much determined that either gold was going to go for the low to mid 190s or that gold was going to go below 177. And as you can see right now, gold has been dropping along with the market. So, like I said in the introduction, that people typically, a lot of times, what we see is that gold will have relative strength against the overall markets, but we're not necessarily seeing that right now. So for me, I would not necessarily be hedging my portfolio with gold at this moment. I would be waiting a little bit, probably toward the end of May, before making a move with gold, as I think it may have some continued downside. But let's take a look at gold right now. So gold is down. Let's see how far it's down from its high. I mean, just based on how the chart is looking, it's only down 10% from the about 10% from its high, so it's in correction territory. So definitely be looking to see if gold holds here. If not, gold, could drop, even further. Let's see where it is in relation to the 50 and the 200 right now. I'm pretty sure it's below the 20 at this point. All right, so it's getting pretty close to the 200-day moving average right now, um, and that's around 171 and some change. Uh, Possible that it could hit there, you know what I'm saying, or it may kind of just oscillate between the 50 and the 200 for a little bit. But like I said, it's currently sitting right at that, just inside that correction territory, um, based on just me kind of eyeing it. But anyway, um, so gold is not one. Let's say I just went based on how gold typically moves in relation to the broader market. So a lot of times gold will have an inverse relationship to the market. So you got bearishness happening in the markets. Gold is typically a go-to if you like to trade bullish positions. So if you like to be uh, in calls, which a lot of people do, because puts kind of scare people in general. So let's say you're in puts, everywhere, and you say, you know what, I'm gonna hedge my portfolio just in case, and I'm just gonna go ahead and get a position, a bullish position in gold. But what you can see has happened is that gold has dropped right along with the market. So while you had great intentions, gold kind of did the opposite of what you were expecting, and you ended up just adding on even more risk, instead of reducing the that overall risk in your portfolio. So right now, I'm of the opinion that gold may not be the best hedge right now, short term at least. But if you're looking to get into gold, long term, this drop is just great. You know what I'm saying? And this is just the gold ETF. uh, a spider ETF, that is. There are many other gold-based tickers out there, but I'm just, for the purposes of this short discussion, I'm just focusing on GLD. But anyway, let's move on to volatility. Like I mentioned in my introduction, volatility, in my opinion, is a great way to hedge your portfolio because at the end of the day, everything, volatility impacts everything. You know what I'm saying? So if I got too much risk to the downside, I can reduce some of that risk by going bullish on the volatility side um, in general, because not the relationship isn't always inverse. So keep that in mind. But for the most part, if the markets are falling, generally the broader markets, that is, generally you're going to see VIX going up. But what I'm seeing on VIX right now is that if VIX is able to hold above this low 30s area and then subsequently break this yellow zone here, I think VIX is going to go to 45 plus. Um, it may happen suddenly, it may not happen suddenly, but I think this could happen over the next uh, 60 days or so, possibly. That VIX may make a move for the 45 to $50 area. So if you are super bearish right now, or even if you are super bullish, you know what I'm saying? If you're really bullish in your portfolio, VIX is a good way to reduce some of the risk in that bullish portfolio. So even on the trading side, if you're in calls, or even if you're just trading stock short term, the same concept applies. So you can go uh, buy some calls. Let's just look at at the option chain for VIX. Like I said, maybe about 60 or so days, VIX makes a move um, for 45 to 50. So because I don't have an expiration that's 60 days out right now, I'm gonna look at the 43 to 78 day expiration. So June 15th, and if I look at um, the calls for between about 40 to 50, I see the prices are about 275 to 175. Got a lot of open interest there, which is typical for VIX, but you know that's pretty heavy there. Um, so that's something that I'd also pay attention to. Let's go a little further out and see what the same area is looking like. The 40 to $50 calls for the July 20th expiration, going for 340 to 190 with, again, heavy open interest. Not as heavy as the June 15s, but still pretty heavy. So another thing to keep in mind when you're hedging your portfolio is, let's say you have a 50K portfolio overall, right? And you're mostly bullish in that portfolio. And so you decide you want to reduce some of that risk. And so you choose to trade volatility. And you say, I'm going to buy some calls on VIX and to account for, you know, a possible drop, you know, whether you're anticipating some sort of piece of news or whatever. You just decide that it's smart to do so. So what you're not doing when you're hedging is trying to make up for all the potential losses. So you're not going to go and allocate 50K to VIX calls. You're not going to do that. What you're going to do is you're going to strategically decide on a percentage in which to allocate toward hedging. So maybe you decide, okay, I want to hedge 25% of my portfolio, and take those funds and dedicate that toward hedging. so that, if there's a drop in your portfolio, the money that you make with that 25% that's hedged can account for a good bit of those losses that you get on the bullish side. So keep that in mind. You're not going, balls to the wall with your hedging. You're doing it strategically, and you're deciding on a percentage. Again, like I said, I may or may not do a video later on that goes more into the quantitative side of hedging. I'll just, kind of think on it and see, what you guys think. But anyway, um, so yeah, that's my humble suggestion when it comes to hedging, and not to be misconstruing this as any sort of investment advice or anything like that. That's just what I would, if I were hedging my portfolio, that's probably what I'd do. Um, so yeah, VIX is a great tool to use to hedge your portfolio. It's not necessarily company specific or anything like that. It's just straight greed and fear. That's all you're trading is greed and fear, and really that's what you're trading regardless of the ticker that you're looking at in the markets. But VIX itself, it's straight greed and fear, like I said. But moving on from VIX, I think that another great hedge that I'm definitely considering is bonds. So bonds have been trading in a bullish trend. Although the markets have been dropping, bonds have continued to have that inverse relationship with the markets. So what I'm seeing on TBT right now is a potential move to the 28 plus dollar range on this, based on this daily chart, this pattern that I'm seeing on the daily chart. So bond TBT is in the middle of a move, and I think it's heading toward $28 potentially. But if JP comes out and says something, maybe interest rates, maybe they're going to do maybe a 25 basis point rate or hike, then I think, maybe TBT stalls a little bit. But if he says, 50 plus, I think bonds are really going to get some more legs or some more gas and keep on pushing toward that $28 target short term. So probably, maybe same thing, maybe over the next 45 to 60 days, we may see that move happening depending on market conditions. So pay attention to that news. Again, you are in a situation where your portfolio is leaning uh, um, one way. You can hedge with bonds, because bonds is one thing. Even from a fundamental perspective, we know that interest rates are going up, and that's bullish for bonds, but it tends to be bearish for certain sectors of the market. So you can hedge against those areas of the markets that are negatively impacted by interest rates going up. Um, and then you can hedge that with tickers. Well, one, you can hedge it with tickers that are positively impacted by interest rates going up, and you can also hedge with bonds. So again, I didn't want to make this video too long, but VIX and TBT are just two tickers that I think people should, or that I will be considering for hedge potential. Again, like I said, there's no one right way to hedge your portfolio. Um, but think about your overall portfolio, whatever your investment goals are, and just go from there. But if you have any questions, feel free to leave them in the comment section. I appreciate you guys watching, and I'll catch you in the next video.